There may be no other brand of product that's more associated with Americana than Coca-Cola. And there's certainly no investor that's more associated with Americans' investing success than Warren Buffett. And there's certainly no product that's more associated with any investor than Warren Buffett is associated with Coca-Cola. I'm Jason Hall. This is Investing Unscripted. And I'm going to tell you 3 surprising things about Coca-Cola and Coca-Cola stock that you probably did not know. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. So first, I want to give you a little bit of background on the Coca-Cola and Warren Buffett connection. Good chance you might already know it, but here is the short version of the long story. Berkshire Hathaway completed its investment in Coca-Cola back in 1994, acquiring 400 million shares. The total cost basis for those shares, $1.3 billion. Now, this is still one of the largest holdings in the Berkshire portfolio. Berkshire hasn't bought a single new share of Coca-Cola since it finished making its acquisition back in 1994. Along the way, it's just been steadily collecting dividends. So here is the first little piece of trivia that you might not know. Since the beginning of 1994, now, of course, it wasn't January 1st, 1994 that Berkshire bought its last of those 400 million shares. They did acquire shares starting before 1994 and then through 1994 before they completed that 400 million share position that they've built. Anyway, since 1994, Coca-Cola's dividend, this isn't the stock performance, this is the dividend growth. It has grown its dividend 844%. That is a remarkable run. There's another part of that trivia that I think is really interesting. So this is like 1 and 1A. They earn Berkshire, because of that incredible dividend growth, Berkshire Hathaway has seen its dividend that it earns from Coca-Cola grow from $75 million in 1994 to $704 million today. That's $704 million a year that Coca-Cola pays just to Berkshire Hathaway. In other words, every 2 years, Berkshire Hathaway earns back more than its cost basis just in dividends that it earns from Coca-Cola. That is a pretty amazing statistic. Now, I'm going to share you something else. One of my colleagues, Dimitri Kalogeropoulos, just wrote an article that published on the Motley Fool's website that you should really check out. I'm going to do a screen share of it here, and it breaks down a really surprising thing about Coca-Cola and the way that it makes money. The company sells a ton of sodas every single year, 2.2 billion daily Coca-Cola products, but most of its sales come from syrups and concentrates. In other words, the Coke that you buy in the store, again, it might look like this. Now, my personal favorite, Coke Zero, or it might look completely different. All of the hundreds of brands that they own, most of those are bottled by other companies. They're bottlers that bottle it and then distribute it to retail establishments. Most of what Coca-Cola does is provide the syrups to those bottlers, restaurants, movie theaters, convenience stores. The syrups, the concentrates, that is the main way that Coca-Cola actually makes money, not selling the product that you grab off the store shelf. Now, I've got one more really interesting fact that I think is super important for investors to know about Coca-Cola. I'm going to pull up another screen here because I want to share this because I think it's super duper important to get that visual representation of exactly what has happened with Coca-Cola, the investment. Again, we highlighted it here, that 844% increase in the dividend since the beginning of 1994. That has been absolutely remarkable. And as a result, Coca-Cola, the investment, has delivered 1,100% in total returns. Again, that's an 11-fold return. Been a wonderful total return. But here is the thing. It's pretty substantially underperformed the S&P 500. I'm going to pull the dividend out. So we're just looking at Coca-Cola and we're just looking at the S&P 500. The bottom line is that Coca-Cola, so widely associated with Warren Buffett, who's so widely associated with investing success and market-beating results, one of his favorite companies, business that has been part of Berkshire for 30 years at this point, has done substantially worse than if he had just bought an S&P 500 index fund. The point is, sometimes even great sounding investments maybe weren't so great. I'm not here to bash on Coca-Cola. This is one of the most wonderful companies in the world, one of the most powerful, durable brands, certainly has a lot of the things that Buffett looks for, really strong economic moats with its powerful brand, the pricing power that it has. It's a low-cost item, but you can buy a cheaper similar product on any store shelf and store brands for sodas any day of the week. People will spend that extra money to buy their favorite flavor, their favorite brand of Coca-Cola product. Those are really impressive things. Growing cash flow per share over years. The company has done all of those things really well. So what's the takeaway? Even wonderful companies aren't always guaranteed to deliver better returns than the S&P 500, and it's so important to diversify over time. Diversify into multiple companies. Make sure that you have exposure to lots of best-of-breed businesses, just as Buffett has. Apple, for example. About the time he was loading up on Coca-Cola shares, Buffett was making it pretty clear from then on through the next 5 or 6 years that technology wasn't an area that he felt comfortable investing. He didn't understand technology, didn't know how to value the businesses, stayed away from it. So the dot-com boom happened, missed that ride up, but then of course avoided the downside. Yet now Apple has become the best, most successful investment that Berkshire Hathaway has ever made. It's put more dollars into Apple stock. Apple has generated more dollars in gains than any other stock Berkshire has ever owned. Be willing to diversify, be willing to find best-of-breed companies and then pay the best price that you can. Now, I have one last thing that I want to share about Coca-Cola, because again, I just spent a couple minutes bashing it, talking about how this great brand that's so associated, the stock that's so associated with Warren Buffett, how it's done worse than the S&P 500, has been an okay investment, hasn't done anywhere near as well as the market. I want to put one more piece of information on this slide. I want to show the annualized rate of return, because I think this is really useful to thinking about how even an underperforming investment like Coca-Cola can still have an important role to play in an investor's portfolio. And I think this is really important when thinking about Warren Buffett's style of investing, for example. So if you look over this run, this 30-year run at this point, S&P 500 generated about 10.2% in annualized returns. That's a really good level of return, and it's certainly a little bit better than the market has over the long term. Coca-Cola, 8.3%. That's still pretty good. That's on the lower end of the historical average. If you look at rolling 20-year periods, rolling 30-year periods, it's on the lower end, but it's still within the range of what would be considered a pretty reasonable average rate of return. But you also see, again, 8.3 to 10.2, you think that's only 2%. That's only 2% a year compounded over a 30-year period, and how that can result in vastly different results over that long period of time. But here is the key thing that I wanted to talk about. 8.3%. Not as well as the S&P 500, but what's it been better than? It's been a lot better than cash. It's been a lot better than bonds, long-term bonds, medium-term bonds, corporate debt, federal debt in the U.S. government, treasuries, the safest thing you can invest in. It's outperformed most other asset classes. Sure, it's trailed the S&P, but it's done better than a lot of other asset classes. So let me tell you, companies like Coca-Cola might not be attractive for a lot of investors, myself included. I'm not looking for the stalwart, pays a good dividend, grows it a little bit every year, might underperform the stock market, but can outperform other ways to get good, steady income. It's not the right stock for me, but it can be the right stock for a lot of people. That is what you're looking for. So I hope this video helped give you some interesting insight into Coca-Cola, how it makes money, how it's done as a business, and then you can think about whether or not it makes sense for your portfolio in the same way that it has made sense for Warren Buffett and Berkshire Hathaway for the past 30 years.